Every time you buy something with a card, a fee is charged. That does not appear on your receipt. In the United States, those fees total over $100 billion annually. That money comes from the prices you pay, whether you use a card or not, whether you knew the fee existed or not. You paid it. There is a fee on almost every purchase you make. It does not appear on your receipt. It is not listed as a separate line item. It does not require your consent, because your consent was not part of the design. It is called an interchange fee, and it is built into the price of nearly everything you buy from a business that accepts card payments, which is most businesses in the modern economy. When you pay for something with a credit or debit card, the merchant receives less than the amount you paid. The difference, typically between 1.5% and 3% of the transaction, goes to the card network and the bank that issued your card. Merchants pay this fee on every single transaction. And merchants, being businesses that need to remain profitable, do what any business does when faced with a consistent cost. They build it into their prices, which means you pay it, whether you pay with cash, check, or card, whether you have a rewards card or a basic debit card, whether you know it exists or not. The person paying cash at a merchant is paying a price that includes interchange costs they are not generating, effectively subsidizing the rewards earned by cardholders at the same checkout. By the end of this video, you will understand exactly how this works, who built this system, and what you can actually do to reduce your net exposure to it. Let us start with the mechanics. To understand interchange fees clearly, you need to understand how a card transaction actually processes. It looks instant to you as the consumer. Behind that instant approval, a multi-step settlement process runs between four parties. You, the cardholder, the merchant selling you something, the acquiring bank, the financial institution that processes card payments on behalf of the merchant, and the issuing bank, the financial institution that issued your card. The card network, the payment infrastructure connecting all of these, sits in the middle. Here is what happens financially in the background. You spend $100 at a merchant. The merchant's acquiring bank pays the merchant approximately $97 to $98. The acquiring bank sends the full $100 to the card network. The card network forwards approximately $97 to $98 to the issuing bank, keeping a small assessment fee. The issuing bank keeps the interchange fee, the largest slice of the difference. You receive rewards, if your card offers them, funded from the interchange revenue your issuing bank collects. The merchant absorbs the cost and adjusts prices accordingly. Now, here is what makes this particularly significant at scale. Interchange fees are not uniform across card types. Premium rewards credit cards, the ones offering airline miles, cash back at 2 or 3%, hotel points, and other benefits, generate higher interchange fees than basic debit cards. The rewards are funded by a portion of those higher fees. This means that merchants pay more per transaction when premium rewards cards are used, and pass that higher cost into prices for everyone. The wealthier consumer, who is more likely to carry a premium rewards card, receives a subsidy funded partly by the lower-income consumer paying cash or using a basic debit card. Research on this effect has documented the transfer, finding that the interchange fee system functions as a mechanism that redistributes money from lower-income to higher-income consumers through price and rewards dynamics. This redistribution is not announced on any receipt. It runs invisibly through the architecture of every retail transaction in the modern economy. And it has been running this way for decades, consistently, invisibly, at a scale of hundreds of billions of dollars annually. Now let us follow the full financial architecture to understand who benefits from this system and at what scale. The card networks, the infrastructure companies connecting merchants, acquiring banks, and issuing banks, generate substantial revenue from assessment fees on every transaction processed through their networks. These networks are among the most profitable businesses per dollar of revenue in the entire financial sector. Their margins reflect the position they occupy, infrastructure that every participant in modern commerce must use, with limited competitive alternatives for most merchants. The issuing banks, the banks that put cards in your wallet, collect the largest share of interchange on most transactions. For premium rewards cards, the interchange collected funds the reward programs that attract and retain high-spending cardholders, who generate more transaction volume, more interchange revenue, and ideally carry balances that generate interest. The rewards are real benefits for cardholders who pay their balances in full, but they are funded by a system that extracts value from every retail transaction in the economy, including from people who receive no rewards from it at all. Now consider the scale. Total interchange fees in the United States have been estimated at over $100 billion annually in recent years. Globally, the figure is several times larger. This is not a marginal cost absorbed invisibly by large corporations. It is a substantial recurring cost that flows through merchandise pricing and is ultimately paid by consumers. Research from the Federal Reserve Bank of Boston estimated that the average cash-paying household in the United States effectively transfers approximately $150 annually to card-using households through the price mechanism described above. The average rewards card holder receives more than this in rewards, with the difference coming from lower income, cash-dependent, or debit card-dependent households. That is not a hypothetical redistribution mechanism. It is a documented, measured, ongoing transfer. Now here is the regulatory dimension. In 2010, as part of broader financial reform legislation, the United States passed the Durbin Amendment, a regulation capping interchange fees specifically on debit card transactions by large banks. Visa and MasterCard lobbied heavily against this regulation. The resulting cap on debit interchange was meaningful, but left credit card interchange, typically much higher, entirely untouched. In the European Union, interchange fee caps were implemented on both debit and credit transactions, significantly limiting the rewards programs that fund themselves through high interchange. European consumers pay lower effective transaction costs than American consumers. As a result, the product available to consumers is a direct reflection of the regulatory environment, and the regulatory environment is a direct reflection of the lobbying success of the institutions that profit from the current structure. The $100 billion annual figure did not appear by accident. It was negotiated, defended, and maintained through sustained industry participation in the regulatory process, and every dollar of it ultimately comes from the prices you pay. If understanding who collects what on every transaction just changed how you think about your next purchase, stay with me, because understanding the architecture is one thing. Understanding why this system has survived decades of documented criticism without fundamental reform, and what you can actually do right now to reduce your net exposure to it, that is what comes next. The interchange fee system has been studied, criticized, and investigated by regulators, academics, and advocacy groups across multiple countries for several decades. The criticisms are not obscure. They are well documented. The system is opaque to consumers. It redistributes wealth from lower income to higher income households through the price mechanism. It creates distorted incentives, where the most expensive payment method for merchants, premium rewards cards, is actively incentivized by cardholders seeking rewards. Retail prices in the United States are estimated to be 1 to 2% higher than they would be in a world without interchange, a cost borne by all consumers, but collected primarily by financial institutions and redistributed to rewards cardholders. Given all of this, why has the system remained largely intact in the United States despite decades of criticism? The answer follows the same pattern this channel has covered in multiple contexts. Concentrated, well-funded interest consistently outperforms diffuse public interest in regulatory processes. The card networks and issuing banks that collect interchange revenue have invested enormous sums in lobbying, regulatory participation, and political contributions specifically directed at preserving the current fee structure. This is publicly disclosed lobbying activity. It is not hidden. On the other side, the consumers who collectively pay for this system each bear a relatively small individual cost, a few $100s annually at most. A few $100s annually is not enough to motivate most individuals to become active advocates for regulatory change in payment systems. The merchant community has been more organized, particularly large retailers and restaurant chains who pay hundreds of millions in interchange annually, and merchant advocacy contributed to the Durbin Amendment debit fee cap. But the credit card interchange market where the largest fees and the most profitable rewards programs operate, has remained largely beyond successful regulatory intervention in the United States. The European experience shows that regulatory intervention can change consumer outcomes significantly. European consumers pay lower transaction costs and receive fewer premium card rewards, a different equilibrium with a different distribution of who pays what. Neither equilibrium is inevitable. Both are the product of specific regulatory choices made in specific political environments, shaped by specific concentrations of financial interest. The current American equilibrium costs consumers over $100 billion annually. It has persisted not because it is optimal. It has persisted because the institutions profiting from it have the resources to keep it in place. That is the same sentence this channel has said in multiple different contexts, because it is the same mechanism operating across multiple different systems. Here is what understanding the interchange system changes about your daily transactions. First, understand the actual economics of your rewards card. If you carry a premium rewards credit card and pay your balance in full every month, you are one of the beneficiaries of the interchange system. The rewards you receive are funded by interchange collected from merchants, which is partially funded by higher prices paid by everyone. In this position, using your rewards card for most purchases is rational. You are on the collecting side of a transfer that runs regardless of your participation in it. But if you carry a balance and pay interest, the interest cost almost certainly exceeds the rewards value. In that case, the rewards are a retention mechanism keeping you in a product that costs you more than it returns. Second, for large transactions, understand that many merchants now offer cash discounts or impose credit card surcharges where legally permitted. These are the merchant passing the interchange cost directly to the card user rather than building it into general prices. Where a cash discount is available on a large purchase, a car repair, a medical bill, a contractor, the discount reflects real savings that were previously invisible in the stated price. Third, for ongoing small purchases at merchants you know accept cash easily, gas stations, farmers markets, small local businesses, cash payment does not save you money in the short term because prices are already set inclusive of interchange. But cash-heavy merchants frequently offer real discounts to cash customers in environments where negotiation is possible. Fourth, awareness of this system is itself useful when evaluating calls for payment reform in public policy discussions. The next time interchange fees or card network regulation appears in a news story, you now have the framework to evaluate what is actually at stake and whose interests are being served by which position. That is not nothing. In a world of complex financial systems, obscured from most people by design, understanding the architecture is the beginning of navigating it deliberately. There is a hidden tax on every purchase you make. It is not collected by the government. It is collected by card networks and issuing banks, built into prices, invisible on receipts, totaling over $100 billion annually in the United States alone. It has persisted for decades because the institutions collecting it have the resources to ensure it persists. Now you know it exists. Now you know how it works. And now you know which side of it you are on and what to do about it. Share this with one person who swipes a card every day without knowing what is happening in the background. And if you want to keep understanding the costs hidden in the systems around you, subscribe to Hidden Truth Files. Hidden no more.